presentation about bank stability, bank business model, and the financial resource costs. But the central idea is that what matters really is the bank business model. The model used by banks, different banks adopting different models, and thus really accounts for the end results. It's at the heart of costs as well as margins, going way back. And I think this is relevant to the theme of banking sector resilience, consistent stability of the banking sector, and also the responsiveness of the evolving business landscape and how to achieve sustainability. But there's an important part of this story which somehow tends to defy conventional wisdom. Because the conventional wisdom would possibly appear that if a country is blessed by natural resources discovered and also being exploited, petroleum, gas, diamonds, gold, that as more you exploit more these resources, then you should have a booming banking sector. But no, that's not what happens. The database that we've been working with is the database of every country, every bank in the world. Okay. So we're able to investigate this. And basically, the story goes, I would see here, let me see what this stands for. That in actual fact, what happens, and this is a fictitious kind of imagery, that here you have groups of guys rejoicing. We have discovered oil. And then you have local chaps saying, okay, brilliant, but what about water is what we need. So this is about the difference of a resource blessing and a resource curse. And the fact that what appears initially as a resource blessing might actually turn out to be a resource curse. Why? Because it's a simple phenomenon around the globe that when countries discover big natural resources, there's a tendency that these natural resources may be actually exploited and be amenable to actually in the lack of clear governance, there might be a tendency to go towards misuse of these resources. If there is a lack of democratic accountability, leading possibly into armed conflict and undermining inclusive and sustainable growth. So under those conditions, which may be rampant in some economies, what initially appears as a natural resource blessing may turn out to be a natural resource curse. But it might also be even much more aggressive than that, especially if the flow of natural resources are accompanied by a large capital inflows, and then there's a consumption boom, which may actually lead to shifts in building portfolios, to the extent that households and businesses may not necessarily be using banks. They may be able to get funded resources elsewhere, and the activity of the banking sector, the intermediation process slows down. So we've known this in the literature for a long time. We actually, since the seminal work of Jeffrey Sachs and Abigail Warner in 1996, who showed actually that the natural resource curse happens, and during that time, basically the economies go into disarray because of the abundance, immediate abundance of financial resources from natural resources. What, however, has been pinned down empirically by doing scientific work is the work by Thorsten Beck in 2011, quite recently, in which they tend to show that there is a high consistency of those countries rich in oil and other natural resources have a less developed financial system. And that the pace of development of the financial system slows down if the system is already advanced. And you can say that for many countries in the world. There are also more work recent which have pointed out the importance of the fact that there is natural resource price volatility, and that volatility impacts the profitability of banks and other financial institutions. Much of that work has been done using aggregate data, macro data. So by averaging the bank productivity, total bank assets, macro inflation, growth and others. So you look at the big broad picture. What has been missing in that is the focus on micro, bank level, bank by bank data, country by country over time. And so we need to ask the question, if you actually dig down into the bank level, taking each bank, accounting for differences in countries, what really matters? Why is it that the natural resource curse may turn into, or the natural resource blessing may turn into a natural resource curse, and during that time, banks actually slow down? So this is why we ask this question in this paper, to pose a hypothesis that it is actually the bank business model. It's the way banks manage risk. The bank risk management perspective is helpful in explaining the financial resource curse. To the best of our knowledge, no other work globally has ever delved into that perspective of relating the relationship between huge financial resources, resource curse, and bank behavior. And we do that because we are able to delve down and look at each bank. And at the end of my presentation, I will explain the differences we take into account in being able to arrive at this conclusion that basically the explosion of natural resource blessing, so much revenue from oil. And the last time I visited, as I go around visiting banks, I went to Angola. They were producing $90 million per day from the oil production. Huge resources. What about the banking sector? Performance of the banking sector? Down. You would have expected. That's why this opposes natural wisdom. Natural wisdom would be Angola would have the best banks in Africa from the $90 million a day generated and dispersed across the economies. Maybe the industry owners, when they want to finance industry growth, they don't need banks. They can easily use any of those resources. Okay, so the role of banks in intermediation on risk management becomes less attractive. That's the essence of this argument and presentation here. But we argue much more forcefully in our empirical work that it doesn't have to be that consistency. It may well be the case that if you happen to be in a country that has come immediately into abundance of natural resources, $100 million per day in oil, it's essentially what the banks do. If the banks do nothing and keep the same bank business model, then they will be out of the banking market. And any financiers, households, companies will actually be able to get this money from governments or elsewhere where the oil resources go, and the banks will be redundant. So the banks have to adjust the business model to be able to tap into this immediate wealth. This is, even if I stopped here, this would be the main message of this presentation today. The bank business model matters, and what does that mean? So for this work, we look into the perspective of the work that has been done over the last, say, 50 years. Remember, finance is young. Finance was actually started in 1958, so it hasn't been around for that much long. There was no thing like the financial economics. It's Milano Modigliani's work in 1958 that broke the contention. Banks have then been, of course, creatively being investigated, and some of the new findings we get are really new. So the novelty of this is to help understand how bank behavior That is the bank business model and the credit policy. Some people hear credit policy. What is financial policy? I understand it. That's the way the capital structure of how banks, companies finance themselves. What is monetary policy? Central bank interest rates and the way they, okay. Fiscal policy, that is government's fiscal behavior and taxation. But what is credit policy? It is you what you see or does. In fact, in time of anything, do I give money to a lender, a company? Do I use collateral, or do I peer into the fact that these people will manage the project? That is the credit policy. And what about the repayment terms? Do you get repayment terms? As I found out in Yemen, whereby basically people were not putting money in banks. For 4 months, I could find that there was no change because basically the banks will be offering something like 17% on deposits, but actually when they take the deposit and they try to buy government paper was just simply about 23, so they would make a loss. There was no investment plan. It was after the war between North and South. So credit policy is very important. That's the decision on why you actually do your portfolio, but also the bank business model in terms of how the banks do business. These two matter, and these two will be so important in the case of, say, Kenya in this case. If Kenya, all of a sudden, this experience, like 2012, when Tanzania found so much gas that I was at the African Union by that time, when we're in serious meetings, say, okay, let's Tanzania expand infrastructure. There should be feeder roads all around. You can even expand the rail. But actually, the concentration will have been how banks will do intermediation, how banks will be able to serve and restructure their business models. What do we know over the last 30 years? We know that there can be financial instability from natural resource costs, very well documented. We know that with a lot of natural resources, there is a low level of financial development. The financial intervention, therefore, the financial assets created in the economy over the GDP, simply put, the levels become down. There will be low levels of financial intermediation. Instead of financial intermediation, you'll get disintermediation. That is, you can actually do borrowing and lending, overlooking without involving the banking sector completely. Okay. You can actually also use markets by actually being able to have instruments and bond analysis instruments that you can design legally and trade. And the banking sector comes in just only to earn discount or a fee on the issuance of those financial instruments, and therefore becomes irrelevant. Although, again, the bank business model may matter. For example, in the UK, okay, banks are, and this is another study that features, banks are highly profitable, but also highly competitive. So economists, how can it happen? How can you have high profitability with high competitiveness? The answer lies in this bundling. Okay. They are highly competitive in loans and deposits in the actual, the bread and butter of banks. They are highly competitive, but they don't earn money. They cannot earn abnormal profits from that competition. The competition is so much from the branches. That's where they get money. They get money from trading instruments, foreign exchange, bonds and others. And overall, when you get the entire profitability of the bank becomes highly profitable. So you do the metrics. The bank is highly competitive. And then your profits, highly profitable around the world. The answer is, and this study of mine, which you can find online, was done in 2006. The governor of Bank of England had just been appointed from the University of Birmingham for a professor, and he came back to give a keynote lecture to one of my seminars. And he says, we are getting a very important signal. The banks are highly profitable, but also they are highly competitive. How does it happen? And then overnight that evening I started doing the paper of using pricing models to be able to understand. And it is this bundling, once you break every bank into the activities done, balance sheet activities, bread and butter. Of balance sheet activities, the fees. And then you can easily see the picture of high profitability can exist with high competitiveness. There's also a study done with some of my PhD students. The three of them, they are former PhD students. The three of them are from Nigeria, of using satellite data to try to see where oil is being discovered in Africa, the increase in natural resource revenue, and bank productivity. Bank productivity is calculated from a production function, where you see that for every input, for every resources in the production of a bank, that is the cost, human resources, and others, there is a high degree of profitability. So you are converting a method via Shepard's lemma, a simple production function into a cost function, and then you can find out the productivity. And we find actually that in the presence of oil booms, bank productivity seriously suffers. Bank productivity is reduced, completely. But again, what is not available in this paper is that we don't impose a bank business model. That if you can find a bank business model that can work, then bank productivity may recover. So what we do, and I'm not going to dwell here on this, there are researchers here who will enjoy this part, but what we do is that we develop a theory, okay? It is here, and I was warned by Madame Betty Correa that I shouldn't go into but just simply that for some of the research. Basically, we develop a model, and then a theoretical model. We then linearize it and put the two main elements, the business model and the loan assets, how they are growing their portfolio, bank portfolio. And we then expand and make permutation. We need to find a channel. What is the channel? How does it work? It's a business model that deals with rents. Rents are the exceptional profitability you get from discovering the oil and how it is used. Does it go into only one person's pocket, or is it distributed, or is it used to form a sovereign wealth fund, or is it used to finance companies? Okay, so that's the way to rents are. So we need the interaction term between the bank business model and also the total rents to be able to discover the channel through which the business model would work. And then we also expand that and try to find whether the relationship is linear or nonlinear. It is assumed in most cases, in most studies in economics, banking, and finance, that there is a linear relationship. Okay, but my colleague here from Strathmore knows that it may not actually be linear. And what we explore is the nonlinearity. We find, for example, that in the immediate discovery of these natural resources, as the amount of oil money starts flowing initially, yes, banks absorb much of that money, okay? And then you get high revenues and high profitability by banks. But as time goes on, if the business model doesn't change, then of course, the low profitability comes in and the slowdown of bank activity comes in, because by that time, companies and individuals are able to finance themselves outside of the banking sector. Okay, and we do all the numbers. This is for all the banks in the world, by the way, all countries or banks. Okay, so, and then we then do a control for regions, for banks of different sizes, for all perturbations. We explore every aspect that maybe our results are accidental. So we have to look for all ways to find the relationship is stable, even if we change the countries. Even if you say industrial countries and developing countries. Even if you say Africa and Asia, okay? And also, we do an experiment with a placebo effect. Placebo effect is you get 3 people, including Victor Murinde, and we all have a migraine. And the 2 of them, you give the Panadol for sure, and the other one you give a sweet. And you see whether it can be miraculous that the person getting a sweet is relieved of pain and the others not. So you do a placebo effect, which is an experimental testing, to see whether you can actually control and see the banks that have connections, political connections, to be able to intermediate more of the revenue from oil or gas or any discovery, And whether these are able to, no, it doesn't matter. It actually doesn't matter about the political connections. Okay. The problem is that bank productivity goes down and profitability goes down. So we also check for that robustness, and I'm not going that. We use measures of riskiness why banks become risky. Banks could be, you could say, you could be forward-looking. So you are looking at the riskiness of the bank from the loss reserves and the loans that actually are delinquent. And but that's, if you need to look backward, then you can use some of the measures, including inventing the Z score, to try to find whether actually the loss or the risk in the bank is systemic. So we do find that it matters that it's not linear, it's non-linear, and it tends to change over time, starting from point zero when the natural resources were discovered, how much money is being generated, whether that is also encouraging capital outflows from the rest of the world, and how the bank business model may change to be able to absorb that increased blessing from revenue. But what should be done? What should be done to be able to change the bank business model? If I was looking at the banks in Kenya or in Africa, where would be the basis for changing the business model? That's what I will end with. Going forward, shaping bank business models in Africa. Which are the parameters you want to do? The first is the role of the interbank market trading, the role of the bank, the role of the particular bank in the interbank market trading. The first study of interbank market trading in Africa was done here in Kenya by myself and two other colleagues a couple of years ago, maybe we went about 10 years ago, and was able to identify that in the Kenyan case, there are banks which are driving the interbank market. We call those, they are at the core. And then there are other banks which are at the periphery. The periphery banks actually only play a supportive role. The main decisions of the pricing microstructure, the prices that are involved, are done by banks at the core. So you have a core and periphery structure in the interbank market. The role why the bank business model may work with the interbank market is because the banks are able to trade a lot of resources from the revenue, from oil and others, by simply being able to disperse the funds to the rest of the bank through the overnight market, through interbank markets. So the participation, how much the bank participates in the interbank market will play an important role, provide a very effective business model to ensure that the bank's profitability is not falling, is not actually being subjected to the natural resource curse. And that paper that I put here, published 2 years ago, is the one that uses topology. You plot the relationship between one bank and another, and one bank, and then you have the whole banks, say in Kenya. Actually, that paper has a Kenyan case study. Number 2, shaping themes and shaping bank business model. I have only 7 case studies. You can have one on Monday up to Sunday, so you can read. Okay. The second is CEO power is the exercise of Betty on her bank, okay, and of course my colleague on the bank. But we find that doing with Ernaz here and a couple of others, we find that if you take banks across the world, again this is done across the world, we find that what matters is national culture in bank risk-taking. By national culture, we don't mean the culture of my people and people and others. No, the national culture, cultural studies in banking relate to the affinity the CEO has to taking risk or not taking risk. Okay, that's the culture. The culture is actually can take risk. No, you brave and you stand your mind, you can take that risk, calculated and then waited upon. So the national culture is the tendency that banks in the particular country tend to behave this way. Maybe in the case of default, they may be redeemed by other banks in partnership with their banks, or maybe the interbank market provides recourse without going to the central bank and they carry, by the way, I'm in trouble. No, you can resolve that within among the other commercial banks in overnight trading. So national culture does matter, and that's who provides a business model whereby, a bank business model whereby the banks can actually operate among themselves and can take calculated risk from time to time. The third element in the business model is the big elephant around the room now, the financial technology revolution. And I would like to invite you, by the way, to the AERC biennial in December. My colleague here, Diana, is here, and she will be welcoming you and running the biennial. The biennial is the fintech revolution in Africa. Where are we? Okay, in the fintech revolution. And the fintech is driving the future banks, and this is my paper in 2022, the impact of the fintech revolution on the future of banking, opportunities and risks. Those opportunities are taken maximally by some certain banks, but some certain banks focus on the risk and therefore may not be able to take action. How quickly they can adopt the recent advances for banking does matter. It will be a particular business model. Now, this paper is, again, based on a survey of banks around the world with some case studies. It does not have nasty econometrics. It is easy to read for every year. The fourth business model is driven by the Pan-African banks. They're all being able to form groups and go outside the country. And on the African horizon, you have the Pan-African banks, hubs, South Africa, Nairobi here for the Kenyan banks that have gone Pan-African. Then you have Nigerian banks and you have Moroccan banks. These are the centers we're observing for the rural Pan-African banks. And we find two findings, and I just record here, that this rise of Pan-African banks has impacted bank stability, especially when we take a case of YM countries. These are the eight West African countries which have the same currency. So they have one currency around the 8 countries in West Africa, and therefore they have the single bank regulation kind of tendencies, and therefore how much they play around will matter, how the banks behave will matter in their profitability. And we find the ability to go Pan-African does increase the performance of these banks. Then item number 5 in the banking manner is bank capitalization. We have had some experiments on the African countries whereby the central bank does prorogate that banks have to have a minimal capital requirement and everything has to change. By the way, it goes back to 1985, Basel I insisted a little bit. In fact, Basel I was kind 1985. It does capital adequacy ratio, simply done 8%, you are done, you observe that. Then came a financial crisis, okay, followed. 1997, they say, no, they have to be capital buffers. Build your buffers so strong, okay, that no wind will knock down your bank, that no tempest will knock down your bank. And everybody changed. You know, in fact, Soludo, my good friend Soludo in Nigeria, became a governor of the Central Bank of Nigeria and went overboard with it. And I always have conversations with him about it because he just introduced huge capital increases. So banks had to merge or to come out of the market. So there are huge mergers and acquisition, okay. Did this solve? No, 10 years later, of course, another financial crisis comes, this time on toxic assets. And I remember meeting in Morocco with all the governors and find, no, why should African central banks have these toxic elements? We're not trading in derivatives, okay. So Basel III, the central bank signed, but not many banks implemented, okay. Still, bank capital plays an important role. And so what we do here is to look at and I think there is a paper here, maybe by Jared and others, which looks into this role, the relationship between building bank capital buffers, risk and profitability, and whether, So that's a very important observation, basically. You have a model that can be able not only to look at building big capital buffers, but also in terms of managing risk and assuring a trend profitability, a forecasting trend for profitability that is detrended against the trend, because the trend is what, profits are going to increase every year. Otherwise, you don't have to declare, you have to declare a dividend to shareholders. And if the trend goes down, maybe you don't keep your job. Okay, so the trended the profitability that it does matter. And then climate risk. Climate risk is so important that now most of the studies done in banking is to see how climate risk can be incorporated in bank costing and profitability models. And that's a very important aspect. In fact, in this study, which was the study in 2020, we are looking at the role of climate risk on companies' cost of capital and access to finance. You could actually substitute and say banks' cost of capital. And cost of capital, simple technical is the cost of debt and cost of equity. Combined, the weighted average cost of capital. So it involves the cost of debt and the cost of equity. The cost of debt is easy to compute. The fighting we have had the last 50 years is how to compute the cost of equity, because that there are about 6 methods and they don't always converge. So we try to find a kind of middle ground. But so here would be the incorporation of borrowers whose loan projects are incorporating climate risk, and whether this could get exceptional way of the way their cost of capital is calculated, and find that then the model would be incorporating the climate risk into pricing loans and financial products for clients, especially companies. That does matter. And I can tell you that within the next 5-10 years, it will be standard. Every bank will be having the software that when you go to get loans, then you have to compute this kind of stuff. So the bank business model that caters for that would be very important kind of adoption. And finally, bank opacity. Banks, of all firms, banks are inherently opaque. What you do, what you see is not what you get. Okay? And what you don't see is what gets you. So there's that kind of opacity. Opacity can be reduced, of course, and the work was done here by Joseph Stiglitz. The Nobel Prize was manufactured here in Kenya when he looked at the information adverse selection. He looks at the information asymmetry and adverse selection. And that information is so important. The ability to have information. So information disclosure by banks is very important. And as opacity reduces, banks being able to be transparent with that information, then it facilitates the expansion of businesses. After all, one can get that information through other channels. In Africa, less so, but in most of the countries through the analyst focus, which can give an extra angle to how the business model works. So in the conclusion, yes, we know that the discovery of natural resources may adversely affect the banking sector, including your own bank. But it is how you use the bank business model that matters. And you want to use the bank business model, explore initially one of the 7. One on Monday and the last on Sunday I have given here, and will be happy all your life.